Hi, this is Jonathan Simon with Horizon Payments, and today I wanted to talk about what are merchant aggregators and when you should and shouldn't use them for your credit card processing. So real quick, this is going to be a short video. First we're going to talk about what are aggregators, how they work, why they came about, and then we'll get to the advantages and disadvantages, and you can decide whether or not they're right for you. So what are merchant aggregators? Aggregators are actually merchant service providers that allow businesses to accept credit cards and bank transfers without having to set up their own merchant account with a bank. So what they'll do is they'll actually process on behalf of merchants using their own account. They're also known as payment service providers, PSPs, or payment facilitators. And you may even in fact know the main merchant aggregators, which are PayPal, Square, and Stripe. How do merchant aggregators work? Well, customers will pay with their bank cards either through a terminal or an online portal. This is fairly common, especially if you use PayPal. Generally, aggregators establish a merchant account and let other businesses accept bank card payments using a sub-ID. So all the transactions are then aggregated under the main account, and the main account handles the processing rates, merchant fees, statements, and all that other good stuff. Aggregators usually assume risk for their entire portfolio. They're responsible for fraud, chargebacks, and generally dealing with all their merchants. Why do merchant aggregators exist? Well, historically, they were started to give payment processing to businesses that were not otherwise able to meet regular underwriting requirements. So, for example, e-commerce. As some of you may remember, PayPal got its start mainly in the online sphere back in the late 90s and early 2000s before they were bought out and became a wholly owned subsidiary of eBay. So aggregators generally focus on underserved, low-volume businesses. And this is definitely a good thing because a lot of these merchants would not otherwise be able to accept credit cards. They have automatic onboarding processes that considerably reduce the cost of application review and data entry. So customer support costs are also generally cut. So what this means for you is that it's very easy to sign up for an account. It may be more difficult down the road if you end up having any issues with it or they consider your business to not be legitimate. Let's talk about some of the benefits of merchant aggregators. First, they have fewer underwriting requirements to start an account. They generally take your contact info and don't usually require financial or credit info. This can be quite good for a new business with little processing history in that they're able to accept credit card payments. Generally, other merchant service providers will ask for a lot of detailed financial history. And so if you're a new business, Square, PayPal, or Stripe may be a good way for you to get a start. They are simple and quick to set up, generally easy to use. The account is managed by the aggregator, so you don't have to deal with a lot of negotiating with your provider. They do actually have quite good rates for low ticket sales. So if your average transaction is under $5, Square or PayPal or Stripe may be good options for you. They generally have what's called a flat rate. So I believe PayPal charges 2.9%, Square charges 2.75% on transactions. They have fewer incidental fees, lower setup costs, and maintenance costs. So often merchant service providers will charge you an application fee or a lot of other initial costs that can make it difficult if you're a new business. They have no early termination fees. And it's actually harder to monitor who generates transactions and associated risk. So this can be both a positive and a negative. Now let's talk about the negatives. Aggregators choose when a merchant receives their funds. Usually it's in 24 to 48 hours, but it can be held anywhere up to 30 days. They are actually quite expensive in their rates for higher ticket sales. So if your average transaction is over $5, then you may be paying too much if you're using Square, Stripe, or PayPal. They have generally not the greatest customer support, and this is mostly because their business model is focused on automatic onboarding and not necessarily retention. They do have transaction and volume limits, so if you end up processing any transactions, let's say you have a high-ticket consulting business and you're going to be taking, say, $5,000 from a client in one transaction, you may be at risk of having your account frozen. They also have lack of underwriting ability that can lead to reserve requirements, frozen transactions, or account holds and terminations. So again, if they notice any sort of suspicious activity on your account, they may take a look at that and freeze your transactions, start holding some of the money that you earn monthly, or possibly even freeze and terminate your account. Unfortunately, merchants have little to no negotiation power with the aggregators since they generally take on all the risk. Like I said, you can't negotiate your rates with Square, Stripe, or PayPal. They have flat rates that they charge everyone, and that's just how it is. They also have the ability to raise their rates, hold your money, or terminate your contract at will. So again, there's generally little recourse for this other than to find another merchant service provider. And it's also harder to monitor who generates transactions and the associated risks. So again, this can be a negative as well as a positive. If you're a new business, it's positive because they're not looking so closely at your business in the beginning, so you have time to maybe set something up. But down the road, if they see any red flags, they can't necessarily see what you're doing or know what your activity is, and they may freeze your account. So why would you choose a traditional merchant account? You have more rights and responsibilities. Your account is in your name. You also have greater supervision of the transaction process. There's definitely more security available and customization. Customer support is usually more accessible, but I don't want to go so far as to say that all traditional merchant service providers have great customer care. It's easier to obtain business loans, and you can get better rates if you have a merchant account. Companies that provide business loans generally don't like dealing with merchants that have Square, Stripe, or PayPal accounts, just because they know that those can be kind of fickle. In conclusion, which should you choose, a merchant aggregator or a standard merchant account? Well, if your business is new and you're just starting out and you are low volume and have small tickets, let's say you're a coffee shop, or you have sporadic processing, let's say you're an online business that hasn't scaled up yet. If you're a new business with little financial or sales history, they will onboard your account. And it generally has simple setup, so if you're not interested in learning about how merchant services works and just are happy to pay a flat rate, then merchant aggregators are definitely a good choice for you. But if you are a higher volume business, you have tickets above $5, you process regularly, and you're an established business who wants more flexible functions and greater control over your merchant account, then you should probably reach out to a merchant processor and begin negotiations for setting up an account. All right, well, I hope this information was helpful for you. If you would like to learn more, you can always contact us at info@horizonpayments.com. Or if you need immediate assistance, click the link below to set up an appointment. Thanks, have a great day.